Today we're going to talk about two companies, Xometry versus Protolabs, and we're not going to look at their offerings from the perspective of a manufacturer trying to pick which company to use. We're going to be looking at these firms in the context of an investor. So which of these companies is the best way to play the $35 trillion manufacturing opportunity? So this is a great diagram that we pulled up, and it shows the difference between what $1 billion stacked in $100 bills looks like versus $1 trillion. And that really puts into perspective how big $1 trillion is. Well, manufacturing is a $35 trillion global industry. And one of the themes that's looking to disrupt manufacturing, which evolved from 3D printing, is often referred to under a collection of different names, such as manufacturing on demand. Most commonly used term would be distributed manufacturing, but you also have manufacturing as a service, digital manufacturing, and the list goes on. But what these terms refer to is the ability for companies to utilize a production platform that's flexible and that can produce items in small lots. So we've been following this very closely over the years. Here's a handful of articles that we've written more recently in 2021. And the two companies that we've been paying the closest attention to would be the two firms considered to be leaders, and that would be Xometry and Protolabs. So difference here, which has been quite debated over the years, which model is superior. Xometry uses a software-driven business model. So it's hub and spoke. They receive all the jobs and then they farm them out to machine shops, and they actually use AI algorithms to estimate the costs so that they can provide estimates on demand before they farm out the jobs. It's all rather slick. And then you have Protolabs, which owns the equipment and manufactures in a closed loop. Now, I'll caveat that by saying they may not necessarily own the equipment. They could lease it, or more recently, some 3D printing firms have been offering pay-as-you-use plans. So Protolabs may have equipment under their control that they don't necessarily own. But the point here is that they're manufacturing under their own umbrella. So when we look at the size of these two companies, Xometry is now nearly 3 times as big as Protolabs. But when it comes to margins, this is quite surprising. So Xometry, this is reversed. Actually, this is a mistake. Xometry has a margin of 26% versus Protolabs at 46%. That's rather surprising, because if Xometry uses software primarily, they should have higher margins. Then we look at simple valuation ratios. We can see Xometry is significantly overvalued compared to Protolabs, and that makes sense when you look at the growth. So when we considered these two business models trying to pick a leader other than using market cap and revenue, we looked at two factors here. So the first was quality. That Protolabs, if they manufacture everything in-house, they can control quality. They have a closed loop platform. They can access all the big data that's produced out of their manufacturing operation and use that to optimize everything. But when Xometry outsources their jobs, they lose the big data picture and they take on the liability of assuring quality. And more than that, Xometry agrees to pricing with a buyer in advance of sourcing the opportunity to a seller. So AI algorithms help them do that, but it certainly sounds risky. When it comes to capital expenditures, Xometry is going to have a capital light business model, which means they can run leaner and require less capital. But you also need to consider, as we said earlier, that a lot of equipment manufacturers offer their machines on a pay-as-you-go basis, which would sort of dull that effect on Protolabs. So we had posited that the value of a closed loop platform seemed to outweigh the benefits of operating a capital light business model. But it all comes down to revenue growth, and the concern that we have with Protolabs can be seen here. So if you look at their 10-year compound annual growth rate for revenues, 14%, that sounds great. Look at 5-year, it moves to 7%. And then when you look at 4-year, it's down to 2%. So they can't even best inflation. That's a problem. When you look at quarterly revenue growth, this is for Protolabs, what over, let's say, 4 years of quarterly revenues. Look how stale that is. There's no consistent growth there. It appears mediocre. And that's especially concerning when you see this chart here on the left. This shows the revenue growth for Protolabs mapped against Xometry. It's remarkable. Look at how quickly Xometry has caught up with them. And we've used, for Q3 2022, we've used estimates from both firms, the lower end of their guidance. But look at how quickly they caught up. And let's say about a year and a half ago, we had made this remark about Protolabs. We said the Rona card has already been played, and now it's time to get back to growth. We'll check in a year from now to see if that growth has resumed. Well, it hasn't. You look on the right-hand side here, you can see the acquisition of 3D Hubs. This is a firm that had a business model similar to Xometry, and critics were pointing out that Protolabs had chosen the incorrect business model, because here they are trying to pivot into a business model that Xometry uses. And you can see the contribution of revenues from that acquisition, which is supposed to help them reach $1 billion in revenues by 2026, which they don't seem primed to do. When you look at survivability for Protolabs, there's another concern. They have $110 million on their books. That's not a lot of money. Gross margins are at 46%. That's great. But look at their shrinking profitability over the last 4 years and marginal revenue growth. Shrinking profitability is just fine if you're showing double-digit revenue growth and you have the cash to provide a runway. But here we see a problem. We see revenues growing at a mediocre pace, and we see losses increasing over time. When you look at what the company says in their latest investor deck, they say they seek to more than double revenue by 2026. That's the $1 billion target. And they talk about this ability to offer a breadth of services, increasing customer share of wallet, capitalizing on low volume production opportunities, hubs. And here at the bottom, it says, consistent double-digit revenue growth as we capture significantly expanded serviceable addressable market, more or less total addressable market. So we don't see that double-digit growth. When you look at what the company plans to hit this year, if they hit top end of Q3 2022 guidance, which is around 129 million, and they hit that again for Q4, they're going to be just over $500 million, about 4.3% year-over-year growth. That barely beats inflation. Here's where they should be on track to $1 billion by 2026. Next year, we should see over $600 million in revenues if they're going to stay on track to hit that target. And they've said it before in their investor deck, double-digit growth. Yet when you listen to their earnings call, where the CEO is lauding their D&I efforts, you don't hear much talk about revenue growth, and none of the analysts pose questions about that. They're very softball questions around the guidance given for Q3. So when we look at Protolabs, we always hate using memes. They're the tool of people who can't articulate themselves, but sometimes they work really well. And this is kind of how we're feeling about our investment in Protolabs. We've been eyeballing Xometry, and we actually went long that firm some months back. I think it was just over a year ago that we went long Xometry, and now we're looking at Protolabs thinking to ourselves, why are we holding this dud? So Protolabs revenue growth has just been stalled for too long now. Management's language in the latest earnings call doesn't inspire confidence. It's all about macroeconomic headwinds and the difficulties they had scaling when the Rona brought them a lot of jobs that they couldn't cover because their platform wasn't able to scale, which kind of makes sense if you think about their business model. But if double-digit growth can't be realized, it's time to exit this position. We've been waiting for too long. So their new CFO was also their head of investor relations. He was just promoted to CFO. So we're going to drop him a note, given that his prior role was around managing investors' expectations, and just query if that's something they can possibly address in the next earnings call. And in the meantime, we're going to take a deeper look at Xometry and try to figure out how they've been able to maintain their momentum through the macroeconomic headwinds. And through this remainder of this year, we'll be considering potentially exiting our position. So please leave your comments in the comments section. Make sure to subscribe to our channel. And thanks for taking the time to watch this today.